everyone, and thank you again for being here. A warm welcome to my panelists. I won't get into introductions because she's just done them. But so let's sort of get into it. I thought I'd start with some context. We're talking about the rise of private capital, and we have seen a little bit of a blip in private capital flowing into India, at least in 2023. We had about 50 billion of PVC. That is sort of, let's say, definitely less than the record high that we saw in 2021. That is one data point. But what we've also seen in the last 2 years is a rise in, record number of exits. For instance, large block deals. Private equity and venture capital firms have been able to make these exits through public markets and in the secondary markets. And we're also seeing a record, we're seeing deal sizes increasing. Those are the few trends that, I thought I'd anchor this session in and, talk about. Maybe we can start now with what is distinct about 2024, your investment thesis in 2024 for each one of you? Nishant, maybe we can start with you.
No, thank you, Ranjani. Thank you, Min, for having us here. Look forward to sharing our perspectives. I think, to your question, Ranjani, private equity and, in general, most of the investments that we do are, we actually do some things quite consistently over the years. So unlike our friends on the venture and growth side who are looking for the newest trends, we're actually doing the same boring stuff year after year after year. And so this year, the focus really therefore ends up being more on, just I would say familiar risk, because there's obviously global uncertainty. There are things which, there's not full clarity on, whether it's interest rates, whether it's inflation. India is obviously somewhat better position compared to the rest of the markets, but still, when you look at the overall landscape, it does give you pause. So from that perspective, I think just staying focused on, at least from a Kedaara standpoint, on your swim lane, areas which you know well, where you have an angle, where you can drive value creation, which is distinctive, which most other firms may or may not have the ability to do, is areas we're focused on. Also staying very disciplined on valuation, on risk reward. There are areas where we would want to stretch if it's a high quality asset and we know the space well, and the areas where we probably would step back. So it's a little bit of offense, a little bit of defense, but more of the same.
Focus on what you know. Deepak.
Yeah, look, I couldn't agree more with Nishant, right? So if you look at the market that we are in today, it's, if you think about it, it's broadly a market which is on balance on the sell side rather than buy side. If I had a portfolio which was fairly mature, I would be taking some liquidity off the top, right? So that's where I would lean in. So given that situation, given we have a young portfolio, as well as your biggest competitor is public market, right? Public market is trading one standard deviation above the 5-year median, right? And Nishant and I were just talking about this, which is maybe this is the new base, but we don't know that yet, and we can't rely on that. So what do? You do things that globally you understand very well, and specifically in India context, what are the sectors that you have the depth to go after? I think infrastructure, private equity, where we have deployed most of our capital, again, our boring industry from that perspective, right? You know exactly what are the assets that would be coming to the market, and you form a view on those assets, and you form a view on the valuation at which you would trade. And that's the way you have to go at it, right? And even late stage growth where we go, again, same situation where we don't go very early. There's no spray and pray. A lot of the crossover capital is gone. Then you have the ability to actually be very disciplined around what is it that you're testing. So it's very similar to what Nishant was saying.
Nithya, can you talk a little bit about what is distinct, of course, but you've also raised a fund a few months ago. So, what are the sectors that are looking interesting for you all in 2024? Mike?
Yeah, I'll speak a bit about both, but just from a strategy perspective, it's an interesting time because you have public market valuations which are still pretty strong, despite growth being, a bit, here and there. It's we're unable to say, which way it's going, but the valuations are strong, and certain private market valuations in some sectors are actually sometimes even at a premium to public market valuations. To add to that, there's a lot of dry powder. People are allocating more to India. A lot of Asia funds have said they are increasing their allocation from 10-15% to 30% plus. So it's a competitive market and a high valuation market and a little bit of uncertainties. So from our perspective, our response to these markets has been, where do you search for value then and keep that discipline on valuation. We've typically in other times gone after category champions. That's been our thesis, to say identify the best company in the sector and pack them, and if you're able to get that selection right, and growth will and growth in profitability and top line will get you there. But probably time to be a little more cautious. So we are moving in high valuation environments to say, can we identify underexploited businesses and where there's confidence to go in and make a change, and then ride the curve of higher and getting the valuations up, entering a little more reasonable. The other response could be looking more at platforms, and again taking a build out risk as against a valuation risk. So those would be two things we may do more of in the next couple of years as we look to deploy this fund. Sectorally, the four key sectors which we've always focused on continue to be there. Financial services continues to be very interesting, and because raw material, capital is raw material, and there's a lot happening in the environment with the Reserve Bank also pushing companies to diversify their their borrowing sources. So capital requirements continue to be high, and valuations, I would say, are largely in check in that sector. Pharma healthcare, we are seeing a lot of activity. Enterprise tech, some of the companies have to grow into their valuation, so we'll wait for that to play out. From among the newer things we've looked at is anything related to the green economy. We kicked that off with a investment in electric mobility, which we did in a platform with the Murugappa Group. But we look more for that because there is, we are seeing a momentum come into that from the whole EPR, the producer responsibility guidelines getting implemented, and there's a roadmap for that. So while it came out in 2022, I think that will get more intense. So we'll look for more among the newer ones. We'll probably look to that, but otherwise stick to these four sectors.
Vishesh, some of the things that she mentioned, valuation being important, the kind of new sectors that, and also building platforms, taking a platform risk. Temasek has actually invested a fair bit of time, and capital in platforms. Can you sort of take us through what is looking interesting in 2024, and are there going to be more platforms?
Sure, thanks, Ranjani. So, I think I will place in context, your original question, which is, how does your thesis look like? And then I'll answer the specific question, right? So, globally we invest behind four themes, and these themes are actually super relevant to India, right? These four themes are rise of consumption, digitization, longer lifespans, and rising sustainability. Sustainable living, right? And all of these themes have, a unique resonance in India, and this is what we have been investing behind for 20 years, right? So India was actually Temasek's first office outside of Singapore where we started investing, right? And that experience has been, very satisfying for us. In the way that we think about investments, we are permanent capital. We invest out of our own balance sheet. And so that affords us the luxury of trying to be counter-cyclical, right? So when you mentioned that last year was actually a decline in foreign investments in India, for us, last year was our most active year ever, right, in the last 20 years. And this, while keeping the discipline, as Deepak and Nishant have mentioned, of being value conscious, of being familiar with the companies that you own, that's been our approach. Now coming to the specific question that you asked, the experience of building platforms. Again, this is a strategy that we've followed globally for a long time. We have built platforms around sustainability, in the software space, in healthcare, and I think we've been on the lookout for that in India for a while, and we have now 2 platforms, one in the renewable space and one in the healthcare space. We've finally found the partners that we think we can work with. We've found the right management teams, we found the right opportunity set, and most importantly, the most value at this point in time. Again, I think platform building is intensely rewarding, but it is also very difficult, right? It takes a long time to do, and there's a lot of slippages that are possible along the way. But we believe that with our permanent capital, we have the luxury of taking a longer term view of this. And finally, I would say that look, today India is in a beautiful place. The macro is spectacular. The quality of entrepreneurs that we have partnered with and backed, we are supremely confident that they will be able to exploit these opportunities in the right manner. And so hopefully things will look better in the future.
Yeah. Ashish, is the Bain view similar with respect to, you're also a global fund looking into India. How is 2024 looking like for your firm?
Sure. It's always hard to go last, and I'll try to make sure I don't repeat what people have said. But I think, listen, if you step back and you look at markets globally where private equity has generally created a lot of value, typically you'll see earnings and cash flow growth. You'll see that growth is amplified by leverage, and then you'll see typically some expansion in multiples, and all of that put together has allowed private equity to enjoy good returns. When you turn the lens to India, if you think of that as a 3-engine plane, this in some ways is a 1.5 to 2-engine plane. Particularly notable is the absence of leverage. So I think the bar on accelerating cash flows is very high in India. I think 2024 in some ways, given the multiple environment that we just talked about, raises the bar on that quite a bit. So that's just the overall mind frame that we bring to the opportunity. And I'd say there are probably 2 things as a fund we are pushing on quite hard. The first is what we call active ownership. So back in 1984, we pioneered this value-added approach to investing. And over the years, we've built an approach to doing it. We've built a very deep team in Asia, the largest on the ground, most experienced. And our sense is that team will really be tested in 2024 and going forward, because we do think that the more active you are and your ability to deliver on value creation plans will be increasingly important in this environment. So that's point number 1. I think point number 2 is what I call deep global collaborations. We operate similar to others in 5 industry verticals. Those operate globally. In any deal we do in India, we'll have a thought partner who comes from either Europe or Europe or the US. And the idea behind that is they bring to the underwriting a perspective on what are some of the lessons we've learned when we've tried these kinds of deals in other markets. They bring a little bit of, what are the recent trends we're seeing in different markets, all of which hopefully allow you to find more differential insight and get more conviction in the prices you're paying. That global collaboration we have also allows us then in the value creation journey to, rely on networks we know, people we know, playbooks we have to drive it. So I think in this multiple environment where everybody's very focused on India, I think our sense is active ownership and deep global collaboration will allow us to push for alpha.
Now, that's an interesting strategy. But also you mentioned that everyone is focused on India, and we are at a conference themed the rise of the Indian spring, and one of the reasons why the rise is there is because of the flow of private capital. In that context, do you think there's a little bit of a hype around the Indian growth? And does that worry you as private equity investors? Because you have to assess investments, assets. Can you talk about that? Maybe Vishesh, I can see you nodding.
Yeah, look, I mean, the cliche goes that, everything that is true for India, the opposite is also true. Right?
Yeah.
So look, I think you're right. The macro environment is obviously, better than it's been in a long while. But you cannot, you cannot take a very macro picture and say that, let's just deploy capital. I think it's, at least in our experience, what we found is that it is extremely, extremely important to do your due diligence to make sure that, governance standards are as you would expect. The quality of the entrepreneur, the ability of the business model to scale, to exploit the opportunity is real and executable. And most importantly, the valuations that you're coming in, are the right valuations, right? So while overall the environment looks quite conducive, but that is not an excuse to not do the hard work, right? And we found that that historically in the past, if you follow these tenets, generally the market is rewarding enough. I think most important, the change that we are seeing recently, and the previous panel talked about it a little bit, is that exits are now beginning to happen at a much higher velocity than at any time in the past, right? Whether they are secondaries, from financial sponsors to financial sponsors, or the public markets or block trades, right? Where companies are able to sell 25, 30, 35% ownership, and it's all absorbed by domestic institutions. I think this is a huge change, and this begets more capital coming in. It gets the cycle going. So I think to put it in a nutshell, I think the opportunity is immense, but you've got to be careful about where you invest and how you invest.
Maybe I can get one more global fund to weigh in on that. Deepak, you have a global view. Can you talk us through how the global community views India, and whether that concerns you, that hype sort of is a little concerning for you?
Yeah, look, we are long-term investors, right? So at the end of the day, there would be cycles, and they're just par for the course. So that's one thing, right? So what you have to do is you have to be long-term bullish on India, but then circumspect around valuation, availability of company, your own depth in doing something, all of that stuff, right? I always say we are in performance management business. We are not in AUM gathering business. For teachers, AUM is what it is, and we take the allocation into markets where we see the most value. And in India, the vintage matters, right? And the ability for us to have infrastructure, private equity, late stage growth, you would dial up in an environment where you are seeing opportunity, where you have ability to seize it, and where you see some of the competition going away and dial down. In terms of, I think I also wanted to talk about platforms, right? So platforms of scale in India trade at a higher valuation because really, really hard to build scale in India. So this is not an arbitrage. When people come in, they look at multiples being higher for bigger places. It's because we have tried and we have built these platforms, and it's a lot of hard work, and not everybody is willing to do that. And because of that, it focuses on that. Now, taking a step back from a global perspective, of course, India is attractive. This is our 6th office globally. Right, we invest in 50 countries, but this is the place we opened our office. In general, when we look at this, the long-term trends for India feel like something that you would have seen in China 20, 25 years back. But the mistake we don't want to make is to think of the growth of India as China. It's going to be extremely different. Our saving patterns are different. Our philosophy is different. Our growth pathways are different. We started off doing service industry and moving into manufacturing, hopefully at this point in time. All of those things have to play out, and you have to play India for India, understanding what are the unique needs of India. That's what people are seeing in consumption patterns today, right? It's not going the same way as you expected it to go, and you have to be really open-minded around and not try to overlay other models from other geography if you want to do India. India is not a top-down geography. You can't spray and pray here. It's bottoms up, and it requires you to be specific around what sort of investments you want to make.
Right. You spoke a lot about building, private equity building scale through platforms. Nithya, you also spoke about it. Maybe you can take this. This is going to be your first experience, actually, building, through platforms, sort of creating a platform. What are the areas that look conducive for a firm like Multiples to, sort of get into it?
So we we've actually built a reasonably good platform in financial services. We set up Vastu Housing Finance in 2015 and built it ground up. So a lot of experience coming from there to build it, and seen through COVID and kind of the company is now going to be 9,000 crores of AUM right from zero in a very touch and feel business which is built out in tier 2, tier 3 cities. So I think that, and we followed that up by, and I have a wider definition of platforms as well. One is to say you are a controlling shareholder, you build it from ground up. The other could be, I would put our investment in, I was speaking about the electric mobility business, where we are a minority investor, but building the platform together with the partner, but from ground up in a new and upcoming space. So just few things in that whole build-out journey. I think it's probably true for most businesses. When you go in and try to create value through operating matrices, is right people, right job continues to remain the biggest lever, and especially when you're building it from zero to know when to pivot to the next level of talent and when to bring that level of talent in has been, I would say, very, very critical in that. I think the other, India is very dynamic, and we are seeing, especially in financial services as well, it's important to be agile. Because regulatory environment keeps changing, so many things keep changing. So there, getting the right data and MIS set up early in the company so that your teams can read the market well and be very agile is, I think, that's the other big learning. And finally, one thing which many entrepreneurs and even entrepreneurial management that you set up in a platform need to think of early is very good risk management system. So I would put it in terms of concentration risk, succession risk, and so on. So 2-3 things which have held us in good stead as we have gone through this platform building.
Right. I thought, we should talk a little bit about the exit phenomenon. All of you mentioned that exits have been pretty good in the last couple of years, which is giving investors further confidence into investing into India. How is 2024 looking for exits? Like we have elections coming up in the next few months. At least it feels like the public markets might be a fair bit volatile for IPOs and those kind of block deals to go through. Is that a concern, whether 2024 will be a ripe exit market? Nishant?
Sure. No, I think Vishesh touched on it earlier, Ranjani. The one good structural positive which is different, which makes you less worried about the hype that you were alluding to earlier, was the fact that there are $1 billion blocks happening overnight, which I don't think any of us sitting here would have believed 3 or 4 years ago.
Yeah.
Right? So it's actually turned the corner quite quickly, which has made everyone, I guess even sitting in the room, confident that this is a trend which is here to stay. As far as this rest of the year is concerned, I think the capital markets at least look quite robust. But as you said, I mean, those could be famous last words also, so I don't want to obviously be a crystal ball gazer at any point. But I think in general, just given where the markets are, where the political sort of pundits are forecasting, it does seem like that this should continue unless something spoils the party. Unlike most other markets, India is unique, wherein a lot of the exit activity is, for most of us, is dependent on the public markets. While there is a very active sponsor-to-sponsor channel also, public markets are a far larger share of exit volume compared to most markets globally, where strategics become the larger share of exits, right? So to that extent, our dependency on 2 channels versus the 3rd channel is a little bit more. So that does present a bit of a risk. But I think exits, at least in our view, will continue to be a big driver even this year, because while India is relatively better, I think versus last year, where exit volumes declined across all markets, India was the only one which had a rise. There is still, a lot of what is called in our industry parlance DPI pressure on most firms, right? Because the LPs, when markets corrected in the rest of the world, were plagued by the denominator effect, allocations to private capital increased, and because of the general notion of this bid-ask spread and endowment bias, because all of us believe our assets are probably worth more than they may be in the market to some extent. It just keeps pushing out the exits to some extent. So I think this year, next year, that pressure will become more intense, and people will have to take calls. So far, people have only monetized the family treasure, which is the crown jewels. But eventually, there is stuff which may not be sort of as sort of top decile, if I may, and you have to still push and do what you can there. But I think everyone's now focused also on, like we think of ourselves as business builders and not just financial investors. How do you really drive value creation in the rest of the portfolio, also to position things for exit? But at least we feel reasonably positive with a lot of plans for exits in this year and next year.
Do you see a rise in secondary funds also, sort of fueling this? Is there more acceptance, at least amongst private equity owners, for a secondary sort of a trade if, say, a public market thing doesn't work out? Vishesh?
Yeah, absolutely. I mean, I referred to it earlier as well. But now you not only have sponsors buying control from other sponsors and companies, but you have secondary only funds that have also come up, right? And it's actually a big and fast growing asset class. So absolutely, I think the more avenues that you have to exit your existing investments, the deeper the market becomes and the richer the market becomes.
Nithya, I want to draw you in on what Nishant said about the pressure to, return. The DPI is going to become more pronounced over the next 2-3 years that he mentioned. What is your take on that? Like the exit in India is no longer a market where exits never used to happen, aren't happening at least. That view has changed at least, I would say.
Absolutely. I mean, we said 40 to 50 billion of private equity is getting absorbed.
Yeah.
But equally, 25 billion is the average exits if you take the last 3 years. A great number, actually, if you think of it that way. So yes, the DPI talk is pronounced, and it should be as well, right? As people are entrusting us with their capital and they do want to see it come back and not just paper valued. But I was listening to all this talk on capital markets and being very attractive this year. It's also important. It's very difficult to time when you're in a privately invested company, because your company has to be ready for the capital markets. You're not just holding stock in the company, because it does take a lot of preparation for the management, the team, the information systems, the compliance, so many other things to be mentally ready to take on. It's quite a different thing to be a publicly listed company, and that transition has to be right. So typically it's very difficult to say markets are great this year, to abhi list kar dete. It's quite, you have to be ready for listing and then wait for the markets to be, it's quite the other way. So unless your companies are ready, but the good news is everything people said about even private equity to private equity, right? That whole engine has really got going. So we do see a lot more of that, and I think that is more secular, because you can pass on your company from one hand to the other in the same private space with the same DNA kind of fund, and that journey can continue further. So I think on exits, our philosophy has been, when liquidity is available from private equity to private equity, good to take it and not try to time the capital markets.
But one good thing about going public is also that a lot of your companies need to improve the governance structure, which has become very important, at least in the startup ecosystem, where you're still setting up systems. How has has governance become more important now? It was always important, is what most investors say. But have you seen any evolution in governance standards in Indian companies? Any of you can take it. Deepak, if you want to go, and then Ashish, we can come to you.
I would say what you said, right? Governance is always important. It's exceptionally more important in India because it's still young. It's in its journey in terms of having deep capital markets, right? So the OTPP was established on that fact, right? Like governance was the biggest thing. It was the biggest differentiator. In Canada, back in 90s when OTPP was established, I think we are living through the era here where that is the biggest driver of your returns. And because of that, you have to think through counterparty selection, right? Like we have seen a lot of noise of people who have come in earlier than us and had burnt their fingers. And a lot of these pains happen not because of, you know, markets turning behind you, because that you can come around, right? Some of the things which are unsustainable or not able to turn around, right? That happens because of the overall governance. Our view in the overall ecosystem on that is you have to understand the ethos of the company that you are interested in. For example, we are investors in hospital chain, right? There are things that we can do to improve that overall chain, but like the clinical outcomes and the mindset and culture of serving people's healthcare need is the most important thing there. If that is there, then private equity can help the business a lot. We can help build it. We can do M&A. We can do, you know, operational improvement. We can try procurement saving. We can put independent board members. All of that stuff can be done. But if the ethos of the business is not right, it's really hard within the time frame of ownership of where private capital comes in. Even for the longer term people, it becomes very hard for you to improve it. So it's paramount and would continue to be. There would continue to be more focus on that as the markets continue to become deeper.
Ashish, on governance, you're also often investing in companies where, you know, traditional-minded business families, you're trying to take that, you know, company into new age probably. Does that become a challenge then, especially when you have to put in place governance measures and all of that?
So again, you know, little difficult for me to answer that question only because we operate at the larger end of buyouts.
Yeah.
So typically the companies we're investing in are much larger and therefore further along their governance journey, especially if they're public businesses that, you know, we've invested in. But that being said, look, what I'm seeing is there a focus on governance? 100%. It's a hygiene factor. It's sort of what you need getting into some of the larger deals. What has been interesting to see over the last 4 or 5 years is the definition of governance is changing, broadening, getting more refined. You know, you're spending more time now thinking about ESG in a broader sense, the impact that you're having on the environment, what you'd want to do about it, how you're operating the communities you are. So the dialogue around governance is broadening. I think historically everybody's pushed on independence to make sure in family businesses and even others, there's enough independence on the board to make sure that the dialogue is objective. I think that is now broadening to say diversity and to make sure there are diverse opinions on the board. So there's been a big push, at least at all of our companies, to ensure independence, ensure diversity, and a much broader range of topics that you capture into governance.
Okay. We still have a few minutes, and before, you know, I open the floor to audience questions, I also wanted to talk about, you know, the funding winter, so to speak, at least in the startup ecosystem. One of the reasons why foreign investment is showing a blip this year is because the VC money has been quite, you know, has been a trickle essentially. How is that likely to change in 2024, 2025? At least two of you have invested in the tech ecosystem. You know, Vishesh, maybe you can go first. Are you seeing that thaw? And then we'll come to you, Deepak.
Yeah, so look, I think what happened in the immediate aftermath of COVID is that, you know, there was a lot of enthusiasm, a lot of ebullience, and you know, I would say a lowering of discretion, right? And anything tech was considered to be, you know, to be a potential multi-bagger, and I think things like, you know, is there a viable business? Is there a path to profitability? Is there adequate governance? I think those questions became secondary, and it became a very FOMO market, right? What that did is that, you know, and a lot of companies, almost every company that was, you know, looking for capital, some which were even not looking for capital got funded at very, very attractive for them valuations, right? And what that did is that, you know, when the inevitable, you know, consequence of this happened, that, you know, the business models were found out to be not so sustainable, and you know, things became clearer. Those companies became trapped because, you know, now you've raised your last round at some, you know, some valuation which you cannot justify, and so what do you do, right? Do try to grow into it? Do you, swallow a bitter pill and try to take a down round? So that was the conundrum, right? And that is why also I think some of the capital providers, some of the more exuberant investors also went out of the market when, globally tech saw a cooling off. And so both these things put together, I think, combined to segment the market into two parts, right? So there are the companies that are viable, that are sustainable, that are profitable, which then were able to grow into their prior valuations and in fact, increase their valuations because, they became more relevant to their customers and to their stakeholders. And then there was the other part which, could not do that, right? And I think the crux, the bulk of the funding winter, as it's called, happened in the latter category, right? Yeah. I think all of us have companies in our portfolios that, that have been in the hopefully former category, and so we haven't seen too much of an impact of the funding winter. I think also what has happened is, we had a wave of IPOs that happened in 2021, right? And those companies went through their journeys, right? Their stock market prices reflect that. They all went up, they all, crashed to much below their IPO prices, and then some of them have now come back up, right? So Zomato, Policy Bazaar, we are very happy shareholders of, and will continue to be for a long time. So I think it's this bifurcation that has happened, and I think companies that are good, that are long-term value creators, that are compounders, do not have a problem today, and I think will not have a problem in the future. I think it's the latter bucket that needs to figure out whether they pivot to different models or they just return money to shareholders or what have you. They'll have to figure this out a little bit.
Deepak, the OTPP view on the funding?
I think Vishesh covered it well, to be honest. Yeah. I think that bifurcation is very true. What we are finding out for long-term capital like us, it creates an opportunity, right? So companies see value in somebody like us being on the cap table, right? That takes some pressure off when you do eventually go and list, right? It allows us to provide liquidity to some of the early investors if the capital market journey has been delayed. So that has created an opportunity set for capital like ours to come in and go after. But otherwise, like I fully agree with that view that Vishesh had, which is like there was a level of frenzy, the frenzy is gone, that allows you to be disciplined, focused investors in these companies. And for the companies that have done well and compounded well, are growing into their valuation, maybe they got value slightly, like one round before to the valuation the way they should have been, but generally speaking, for the more sane companies which focus on cash flow, which focus on profitability, the market is still there and there's plenty of demand in terms of capital coming after them. They would take their time, they would do the due diligence as it should be, but otherwise things are fine.
Yeah. Okay. So if there are any audience questions, we can take them. Please keep your questions short if possible.
Hello, everybody. My name is Shirsho Basu. I work with UBS. So first of all, I would like to thank you for your insights on the private capital side. My question to you would be, what are your thoughts and perspective on the current FDI scenario of India? Anything that you think will happen? Will it gain more traction? Anything big that is being planned, or can we expect something on that side?
Shall we take one more question and then you can answer?
Hi, Rishabh here. A quick question, anyone can answer. Your view, so probably 5 to 10 years back, we had a very clear-cut bifurcation between a deal which is a private equity deal versus a strategic deal. So is there a trend which you guys are seeing where strategics are also becoming equally aggressive? And if yes, is there a change in strategy at your end? Do you see them as a competitor, or do you see them as a partner going forward to collaborate with?
Yeah.
Thank you.
Anyone can take.
Yeah, maybe I can try to answer that, right? So I think, as we talked of platform building, right? What does that mean? That means that you are creating a platform which, is another name for a strategic, right? The platform behaves like a strategic, right? Also, I think, at the end of the day, value gets created when there is strong industrial logic, right? Now, whether a private equity, fund owns an asset or a strategic owns the asset, true value will get discovered and unlocked when there is industrial logic, right? So if there is a strategic that has an existing distribution system who is looking to buy a brand, they can just plug it into their distribution and therefore they can pay more value for it. Because they can extract more value from the brand, right? And a private equity would not do that, right? So I think you're right. I mean, the artificial bifurcation of this is private equity owned and this is strategic owned, I think that will converge. I think all of us on stage here would be very happy to partner with strategics, as long as that industrial logic exists, right? What is the best way to unlock value? Whether it is private equity ownership or strategic ownership, whichever wins the day will take the deal. That's my view.
Just to follow up to that, how is it working with strategics as a private equity person? Do you have a lot of room to maneuver and, take decision making in terms of decision making?
I can take that. We've recently partnered, we've announced that
the Murugappa group
with Murugappa and then with the Birla Microfinance Ventures. The good news is because private equity has been around for so long, there's a lot of acceptance now on what it means to take this capital. And not only our investment, you see Mahindras have taken for their electric vehicle, Tatas have taken for their, for their electric vehicle venture. So you see a lot more industrial groups actually partnering, to your question as well, and inviting private equity in, which traditionally wouldn't have been the case. Because there is, stricter capital allocation even at the groups to say, where do I want to put and how much capital do I want to put into this, and why not bring in the, private equity to. So I would go on to say that from ability to get your terms in and ability to influence, and actually there's acceptance that these are sectors which may be new, and we may not have all the boxes ticked on it, and it's good to get the outside view in. That's definitely changing, and I'm happy about that. I think we didn't answer the other question, but I was going to tell the gentleman on FDI he should probably ask the finance minister when she's here in the evening.
Yeah. Yeah. Yeah.
So, can I go ahead?
Yes. It may be difficult for them also to answer a policy question. That's also why.
What I'm trying to understand and gauge is, what do you think is the current scenario? What is your perspective on it? Is it enough? Is it not enough? Do we expect more? Is something else coming in? What is the current scenario?
Is there going to be, basically foreign
Look, I think we all represent FDI in some ways, right?
Yes, you do.
We are seeing allocation of more capital to India. So there is definitely more capital that India is attracting by virtue of what we were discussing earlier, superior growth relative to other markets, a set of enablers which will hopefully attract capital. Capital is generally reasonably discerning and efficient, and therefore if this is the relative oasis that it sees from a risk-reward perspective, it will come in. So I think the general trend is positive. It's incumbent on all of us as participants in the ecosystem to be judicious around how we use that capital and make sure we deliver a return, because capital is coming for a return eventually, right? If it ends up being what happened in 2007 where the hype didn't play out, then obviously it'll mean more challenges. But at least in our view, again, there are structural differences this time which will hopefully, keep things in check. But obviously the story has to play out.
Cool. Thank you. We'll take that.
Can I go ahead?
Yes.
I am Manu Bhandari. I am building schools for Bharat, which is the tier 2 and tier 3 cities, Skyworld School Group. So my question is concerning private capital to micro and SMEs. For the private equity business, the economy of scale for investment means that the larger ticket sizes are preferred. The tech companies can still get away with smaller ticket sizes. Larger companies, of course, are it's easy for them to attract investments. Yet our growth over the next 10 years is going to be powered by the small and the medium sized enterprises. So how small, the smaller ticket sizes, when will they be big enough to attract attention of private investors like yourselves?
All of them invest in very large deals actually. But just is there scope for private equity funds to come up with smaller funds maybe to make it more feasible to invest in Indian MSME segments? Like, will it become profitable? Does it require a change in PE models?
I would say, I mean, look, for us, like we are on the larger end of the scale, so for us it becomes very hard. But there is impact capital which is coming in, where a lot of investments are happening, and if you put capital on a threshold, right? There's philanthropy here, there's development capital here, impact capital is somewhere in between, and there is commercial capital. Like we all represent the commercial capital. It becomes very hard for you to go on things which are not of scale, but like there are other capital providers, and that market is deepening from that standpoint. But it's I don't think the participation, at least from our perspective, would be harder unless we have a sleeve for impact capital where we would be allocating to those funds. But direct investments from large capital provider would be harder. At least that's my view.
Yeah, maybe we can conclude on that note. I'll encourage all of you to, meet our delegates, meet our speakers offline. And on that note, let's give them a warm, applause for answering our questions.